Good afternoon, everyone, and thank you so much for joining us for today's webinar on the Simplified CECL tool, Best Practices. My name is Allie Lamberski. I am a credit union training coordinator here at the Office of Credit Union Resources and Expansion at the NCUA, and I will be the moderator for today's program. Before we begin, I do have just a few administrative announcements. If you are having any difficulty hearing my voice, please go ahead and adjust the volume on your screen. If you're still having difficulty after that time, please use our Q&A feature in the right-hand corner of your console to go ahead and send us our message, and our tech support team will be with you right away. In addition, please make sure that you do allow pop-ups from the site so you have full access to all learning material being displayed today. And again, in approximately 2 weeks, this webinar and all material will be uploaded to our learning management system. It will be available for on-demand viewing with closed captions as well. In order to access our learning management system, you must have an account. The good news is it's completely free for all credit union employees and volunteers, so there is zero charge for account setup and access. To access our LMS, please visit ncua.gov/support services, select Credit Union Resources and Expansion, and further select Learning to have access to over 200 courses. Before we begin, I do also have a brief disclaimer I must read to you. The materials presented in this webinar are intended as an informative and educational summary of general information and best practices when using the CECL tool. The NCUA has taken reasonable measures to ensure the quality of the data and other information produced by the NCUA that is available in this presentation. The NCUA, however, makes no warranty, express or implied, nor assumes any legal liability or responsibility for the accuracy, correctness, or completeness of any information that is available through this presentation, nor represents that its use would not infringe on privately owned rights. The slides are intended for educational and discussion purposes and do not constitute legal advice nor replace independent professional judgment. Reference to any specific commercial product, process, or service by trade name, trademark, manufacturer, or otherwise does not constitute an endorsement, recommendation, or favoring by the U.S. government or the NCUA. This is going to be our agenda for today's webinar. I will be giving a brief introductory remark as well as introducing both of our speakers who have joined us here today before turning it over to both of them to begin our presentation on the Simplified CECL tool, Best Practices. And we will also have a brief Q&A session at the end of today's presentation before closing out with our contact information. Before we get started, I do just have a brief polling question. What asset range represents your credit union? A, 0 to 50 million, B, 51 to 250 million, C, 251 to 500 million, D, 501 to 1 billion, E, greater than 1 billion, and F, not a credit union. This just helps us get a better idea of what credit unions are joining us here today. So I thank you for just taking a few brief moments to go ahead and answer this question. All right, perfect. Thank you guys so much. It looks like we have a fantastic mix of credit unions with us today. I hope that you will all find this presentation very informative and helpful. So we'll go ahead and we can get started. Since its launch within the last year, small credit unions have been able to use the CECL tool to develop their allowance for credit losses. This has regularly been one of our most requested webinars, so I am so excited to have representation here from the Office of Examination and Insurance. And we thought that this was a fantastic time to be able to review the best practices for the CECL tool and provide any opportunities to ask any additional follow-up questions and how it can help your credit union. So like I mentioned, I am joined today by representatives from the Office of Examination and Insurance, Chris McGrath and Trey Damron, who will be sharing information on the CECL tool with us. Chris McGrath is currently NCUA's chief accountant and serves the credit union industry with advice and guidance on the application of generally accepted accounting principles. Here at the NCUA, he has served as its budget officer, as well as leading financial reporting on its insurance funds. Since joining the NCUA in 2004 under McGrath's tenure, NCUA earned its first Certificate of Excellence in Accountability Reporting from the AGA for the 2016 annual report. Trey supports E&I's division of the chief accountant as its senior policy accountant. He joined the NCUA's Office of the Chief Financial Officer in 2012 as an accountant focused on financial reporting, governance, risk, and controls. Trey has been instrumental in the NCUA earning clean audit opinions on its funds, accounting for losses on taxi medallion loans, and the closing of the temporary corporate credit union stabilization fund into the share insurance fund. So I'm very excited and happy to introduce both of these wonderful gentlemen, and I will now turn it over to you both. Thank you so much.
Thank you. Hello, and thank you for that warm welcome. As you know, I'm joined here by Trey Damron. He's our senior policy accountant, and he's an expert on generally accepted accounting principles, internal controls, and governance. Today's event will focus on the Simplified CECL tool. The presentation is about 45 minutes, and Trey and I will answer your questions at the end. Of course, please send your questions in, and where we can, we will answer them right away. So let's get to it. I want to send a big thank you out for all those who have downloaded the Simplified CECL tool. It's been incredible that each quarter, the latest version of the tool has been downloaded more than 3,000 times. We're glad for the acceptance of the tool, even if some are using it to check or validate their own CECL models. There are nearly 3,000 credit unions with assets of 10 million to 500 million. As of September 30th, 90% of those credit unions, those 3,000 credit unions, have adopted CECL. And on average, the decrease to their net worth has been about 10 basis points. Put another way, the hit to the net worth ratio on average is less than 1% of the net worth balance. We're also glad for the 84 credit unions with assets of less than 10 million who have adopted CECL. Our hope is that more small credit unions will adopt CECL and use the Simplified CECL tool. We believe that it will provide more accurate information for them to manage their loan portfolio. Next slide, please. This and the next 3 slides provide some background. The Simplified CECL tool was designed for credit unions with assets under 100 million. The majority of these credit unions are of the size and complexity envisioned by FASB for the weighted average remaining maturity method, also referred to as the WARM method. Of course, credit unions management should confirm that the CECL tool is appropriate for the size and complexity of their business. While the tool is designed for credit unions under 100 million in assets, larger credit unions can use the tool. For all credit unions, we ask that they make sure the WARM factors provided within the tool are comparable with their loan portfolios. We will get to that later in today's presentation. Next slide, please. To me, the WARM method is very similar to the old incurred loss method. With the incurred loss method, we took a look at the outstanding loan balance, or we took the outstanding loan balance, we multiplied it by its historic loss rate, and made qualitative and environmental adjustments to get to our best estimate. WARM is just like the old method, but we add the life of loan concept. That is, losses are recognized over the life of the loan. And qualitative and environmental adjustments keep current conditions and add reasonable and supportable forecasts. So the long and short, the WARM method is the old incurred loss method with the add-on for estimating losses over the contractual life of the loans. We built the Simplified CECL tool to include all the elements of the WARM methodology. Next slide, please. The tool is updated quarterly and posted to the NCUA website so that it can be used timely for the related call report cycle. Because we know auditors will take a look at the tool, we have developed and posted documents such as the model development document to facilitate the audit process. And we are available to answer questions as they come up. Your previous questions inspired our best practices that will follow in today's presentation. Next slide, please. First, we want to bring attention to the December 20th announcement on the CECL transition amount. This is also referred to as the CECL Day 1 adjustment. For credit unions that adopted CECL in 2023, they received the benefit of an add back of the CECL transition amount into their net worth ratio for prompt corrective action. This add back is amortized over 3 years. We noted an error in the language in the regulation for determining the final value. This announcement just fixes the obvious. For the vast majority of credit unions, there is no change in their CECL transition amount. There's nothing to do. However, if a credit union has an audit adjustment to its original Day 1 adjustment, then the CECL transition amount becomes that value fixed by the audit adjustment. The intent of the CECL transition regulation was to allow for audit adjustments should they occur. Slide 14. Next slide, please. We always like to have a visualization. So here, a common question that comes up is, how does the amortization work for the CECL transition amount? So in this visualization, we can see the way it is amortized over 3 years. At the end of the first year, the fourth quarter of the calendar year for calendar year credit unions, the add back is 67% of the CECL transition amount. At the end of the second year, the add back is 33%. And at the end of the third year, the add back is nothing because nothing's left. So over 3 years, this is how the amortization works. This is all done by NCUA based on the date of adoption and the CECL transition amount, both entered into Schedule G on the call report. So we do this automatically. All right, next slide, please. So let's get started with the obvious. Adjust negative loss rates to the expected loss rate. Negative loss rates are caused when recoveries exceed charge-offs. As we know, recoveries lag behind charge-offs and may not be related to the 3-year look-back period. So if you see a negative loss rate, please fix it. Also, the same goes for zero loss rates. Under CECL, if the historical loss rates are zero, well, in looking forward, there is an expectation that there will be some level of loss. CECL requires estimating losses, even if the risk of loss is remote. And CECL includes current conditions and reasonable and supportable forecasts. Again, this is forward-looking. So as you look into the future, unless there's a guarantee, there is a risk of loss that needs to be quantified. Next slide.
Chris, we have a question that has come through, and the question is in the examiner's guide, it discusses allowable materiality for the allowance for credit losses and notes that a credit union policy could, in quote, clearly state when an adjustment to the ACLL account is not required based on an immaterial amount or percentage. And the decision to establish limits should consider the impact on income and net worth. The question is materiality a part of CECL or not?
In thinking about CECL, in thinking about any type of model, we should come up with our best estimate, irrespective of thinking about materiality. My thoughts are materiality is done at the end of the process, looking at the financial statements as a whole and looking at the financial statements as a whole and the users of that financial statement, is the allowance for credit losses, accurate? Is there not a material, we want to make sure that it's not a material misstatement of the allowance for credit losses. Trey, do you have any thoughts to add?
I could add that since materiality is both a qualitative and a quantitative structure construct, it's something to consider that when you do make your estimate, you're taking a look at it. It's not strictly a number decision that's made. Look at qualitative factors and look at the whole picture. before deciding if an estimate adjustment is immaterial or not. Also, materiality is a bit of a conversation rather than an endpoint. So that's a discussion that typically would go back and forth with your auditor or your independent accountant or advisor. So, make sure that materiality isn't just a one-stop, it's a conversation. It's something that's fluid and should be looked at from period to period.
Fantastic. I was also thinking about that, I know credit unions have policies out there where if their movement of the allowance for credit losses is, within a certain threshold, they don't book the adjustment. But again, I get that gets all back to like, materiality is, to your point, a conversation. So, credit unions should take a look at their policy to make sure that, they're accurately reflecting information that is usable, that, allows users to interpret their financial statements. Okay. On to, well, actually, an additional thing about loss rates. The Simplified CECL tool is like all models. The data used within it is not the most current. We have to get that model out there by the end of the quarter so that you can use it. And there's a lag, especially with the loss rates. So while the warm factors are updated quarterly, the average 3-year net charge-off rates are updated annually. This happens with the March version of the tool. Thus, the loss rates for the December 2023 tool are a year old. Please assess your current loss rates, your current loss trends, and make appropriate qualitative adjustments. For instance, if your delinquencies are trending higher, this infers increased losses to reserve for. I've been asked, since you update the tool quarterly, why not include the most recent losses in the, from the call reports? When we were developing the tool, we could not find a method to analyze the partial year losses. When we were analyzing it, the best loss rates came from quarter 4. Next slide, please. Okay, here we have warm factors. The warm factors provide that life of loan estimate required by CECL. We're supposed to recognize losses, credit losses over the life of the loan. Just as we want loss rates to be reasonable, we want the life of loan factors, the warm factors, to be reasonable. Compare the weighted average maturity, or WAM, of your portfolio to that of the tool. For the tool, the values are listed in tab 5. If the difference is less than 10%, in most cases, the warm factors do not need to be adjusted. However, if the difference is more, that is the warm factors, the difference is more than 10%, the warm factors should be fine-tuned. A common method is the rise-run approach, also referred to as a pro rata adjustment. This is demonstrated with the Excel image in the bottom right-hand corner. The Excel image at the top is a reminder of the way that the weighted average maturity is calculated. Note that the maturity column is remaining months on the loan. Next slide, please. In this slide, we want to take a step back and check the overall results of the tool. For number 6, check the reasonableness of assumptions, like using the treasury spread as a leading indicator. The Federal Reserve Bank of New York predicts the probability of a U.S. recession as 63%, and that was as of December 31st. Thus, all loan portfolios that would be negatively affected by the recession should reflect a higher risk of loss. That is, the assumption is applied across all applicable loan portfolios, and there is no cherry picking of assumptions that may skew the results. Also, look at assumptions naturally made that could be wrong. I call these like subconscious assumptions. Like when we walk into a room and we turn the light switch on, we expect the lights to work. We often think that templates are calculating values correctly. And I am sure for many of you, you have been surprised when a formula in Excel that you thought was right was wrong. Mind you, the tool is locked down to minimize errors with formulas. However, because data can be cut and paste versus copying and pasting, that is, data can be cut and paste within tabs 0, 2, and 4, there's a risk of breaking formulas. And of course, this is usually obvious because that REF, or ref error, shows up on other pages. Of course, my favorite key is always Control-Z to undo my errors. For 7, check your inputs and have a second set of eyes review numbers, especially those values for loans that are individually evaluated. For 8, please carefully complete the checklist on tab 7 and make sure you have support for each step. There is an internal control saying that if it's not documented, it doesn't exist. And for 9, what's the story that's being told by the tool? For instance, as an example, the allowance for credit losses has increased because borrowers are holding on to the loans longer. That is, with higher interest rates, less people are refinancing. Thus, there is more risk exposure because loans will be on the books longer, will be outstanding longer. Or another example is we've included qualitative adjustments to increase the credit loss estimate because of the probability of a recession being 63%. Next slide, please. Completeness. Always think about what could be missing. Take a step back and think about, do I have everything? What could be missing? For item 10, do we need to individually evaluate some loans? For me, when a loan is delinquent, its risk of non-performance is higher than the loans that are performing and should be separately evaluated. Now, accountants are split over this. Some reasonable minds may differ. Some accountants argue that if loss rates are lifetime losses, then the delinquent loans are part of the pool. And some argue the opposite, that the risk characteristics of delinquent loans are now different from the pool. To me, when you have superior information to estimate credit losses on an individual loan, the conservative approach is to pull it out and individually evaluate it. And this is often the case with commercial loans. And now to item 11, just scan for other assets that are subject to CECL. That is, scan for something that should be covered by CECL, which has not been picked up yet. While they may be outside the simplified CECL tool, like with credit losses on loan commitments, they still need to be addressed in your books and records. Next slide. Qualitative adjustments. Qualitative adjustments are part art and part science. Finding that logical leading indicator is tough, and it needs constant reassessment. The standard proxies or indicators to look at are the macroeconomic factors such as inflation, unemployment, interest rate, delinquency rates, and the home price index. These can give a general idea of the stability of the economy and the creditworthiness of borrowers into the future. For instance, just taking a look at the home price index recently published, New Orleans is showing a year-over-year decline of 1.1% in its home price index. This means there's an increased stress on mortgages and a higher probability of defaults on mortgages. Indicators can be found through sources such as Moody's Mortgage Banking Association or the Economist Intelligence Unit. Also, the Federal Reserve offers some short-term forecasts. There are other factors that should be considered, such as industry-specific factors. We know that when commercial real estate, well, it's getting a bit it's getting a bit volatile. So like if the general market condition for well, I can't speak here. I'm trying to take two. If the general market condition for a specific segment has a poor outlook, well, that should be accounted for in the expected loss. Occupancy rates have been decreasing since the shift to the work at home in 2020. And the general market outlook for commercial real estate remains volatile. And this should be reflected in the outlook for this segment. And there are also government factors, such as policy changes, that can also change future credit losses through market volatility. You guys know this one. We have all been watching the Federal Open Market Committee and the setting of the target federal funds rate, because we know how that affects our business. And for number 13, qualitative adjustments should capture any missing risk that is not in the quantitative credit loss estimate. These analysis should be backed up by trend analysis. So these adjustments should be backed up by trend analysis, back testing, or benchmarking. These are valuable exercises to verify the validity of the Q factors. The accuracy of the adjustment should be well documented and supported by evidence when possible. Next slide, please. Now, this is one of my favorite best practices, stress testing. And we have an Excel here where we have gone through and increased the loss rates on all the loan portfolio segments by 1%. We need to see how sensitive the credit loss estimate is to changes of our assumptions. Performing a stress test utilizing a change in the loss rate can give an idea of what might happen in an economic downturn. The impact can be used to determine the credit union's current stability and the performance of a loan portfolio segment. It also gives insight into the key drivers of the total estimate for credit losses and how volatile the estimates are to changes, to inputs. This would also be done with warm factors. Adjusting warm factors such as for changes in prepayment rates, prepayment speeds, also tests the stability of the credit loss estimate. Rapidly changing interest rates, like we have seen with shifts in the prepayment rates, will affect our allowance for credit losses. And of course, as we saw with high interest rates, people are decreasing their refinancing, keeping onto the loans, and these prepayment speeds have slowed. But as the cycle changes into the future and interest rates are starting to decline, we may see prepayment speeds pick up. And again, CECL is forward-looking, so we have to look into our crystal ball and feel out. Again, this is part art and part science, how these changes will affect our estimate for allowance for credit losses. Okay, these slides will be made available, and of course, we are open and available for questions. Of all the best practices, again, I like stress testing because it is the most informative and it helps explain the story that the tool is telling. In this example, we can see that a 1% increase in the loss rates has a significant impact on new vehicle loans. That is because the loss rate of new vehicles is very low, and a 1% increase more than doubles the loss rate. Because this portfolio segment is sensitive in this area of, say, new vehicle loans, we should make sure that the assumptions, particularly on this loan portfolio segment, are robust to ensure the accuracy of our credit loss estimate. Now we've come to the end of our presentation and we're ready for some questions.
So before we go to the Q&A session, Chris, I have another question. That's about stress testing. What indication do we have from credit unions currently that they are employing stress testing into their validation models?
Unfortunately, I've not I don't have much insight or line of sight on that. I'd be appreciative if you guys could reach out and talk to me about it, but I have, at this point in time, I don't know. I haven't had much feedback on that.
I imagine as as CECL's implemented and we have at least one examination cycle, we probably would have more information on that.
Definitely.
All right. Thank you so much, Chris and Trey, for this wonderful presentation. Like you both mentioned, we did get some additional questions here in the chat as you guys were presenting. So I'm actually going to also pass it off to Ron, one of my counterparts here in the Office of Credit Union Resources and Expansion, just to go through a couple of those questions with you guys quickly. Ron,
Great.
I will pass it over to you.
Great. Excellent. Thank you, Allie. And thank you so much, Chris and Trey, for a great presentation. And to follow up with, before I get into the Q&A, we did get questions about the slides. And to follow up with Chris said, yes, they will be made available when this recording is uploaded to the learning management system that Allie talked about at the beginning of this presentation. So you will be able to download a PDF version of these slides once we have everything up on NCUA's learning management system. So our first question is, we have a question about timing for CECL adjustments. Since we have to close our financials before we file the 5300, which is then used for processing CECL using the tool, we don't know what the required periodic CECL adjustment should be until after the quarter end financials are posted. Does the NCUA or examiners have any concern about any CECL adjustments being made at the beginning of the following quarter instead as of the CECL effective date?
A little confused by this question. Let me just kind of run through the cadence of the producing of the pool. And it's use in closing the books as well as doing the following call report. So, currently we have the December 2023 version of the tool out. It was released prior to December 31st year end. And the idea of getting the version of that tool out was for that tool to be used in closing the books for December 31st, 2023. So, the tool would be used, input would be made, it would be vetted, and that estimate would be used for, the estimate for the allowance for credit losses would be used in determining and booking the adjustment to the allowance for credit losses as at December 31st, 2023. So that's would be in the books and records. And then, of course, because it's in the books and records, that's what would flow into the call report, which would be filed later on for December 2023. Is there something I am missing with, or is there a nuance of the question that I may not be getting at?
We will ask the asker to follow up in the Q&A text chat if they have more to add, and then I'll bring it up to you if I see it. Thank you so much, Chris.
Oh, no worries, because sometimes I know that depending upon the service provider, they don't allow prior periods to be opened. So, but usually there's a period of time after month end or quarter end for the books and records to be closed, and that's and that's usually a month, so not a month, but days or weeks after that that period end. That usually gives enough time.
Got it. Thank you. Next question. After using CECL for 12 months, we are seeing that we need to make an adjustment. Are we still able to make a one-time adjustment to undivided earnings?
In general, the answer is no. The exception is if there was an error with the original day one adjustment. That is, there was an error in the model, or error in, this is all new to us. So I get talked about with the recent announcement for the final determination of the final CECL transition amount. If there's an audit adjustment, where the auditors come in and take a look at that day one adjustment and said, oh, hey, it should be something different, then adjustment, then the day one adjustment can be made to undivided earnings. But in general, the estimate that you had at the beginning of the year is what will continue, unless there is something wrong with the model we're using or or an error in the assumptions. Trey, any thoughts to add to that?
None. I did see through the chat that the commenter said that they never made an original day one adjustment.
Oh, okay. So, okay, we've had this question a lot, and basically, GAAP, to be compliant with GAAP requires that adjustment to be made effective the beginning of your fiscal year. So if your calendar fiscal year, if your calendar year is a fiscal year, then you'll have to go back and do an effective adjustment for January 1st, 2023, and pull that through undivided earnings and straighten out your books and records and income statement for the entire year.
Very good. Thank you, Chris. Our next question, and thank you also, Trey. Our next question is, with the negative and zero loss rate, it was noted as best practice number 1 and number 2, but ACS was noted at the end of the $0 loss rate. Are both best practices, or is there a requirement under ACS? I'm sorry, ASC.
Oh,
And clarification,
Yes.
ASC is the topic 326.
okay. So, I mean, okay, ASC or ASCII is the FASB reference. The codification of GAAP, and section 326 is current expected credit losses. So when I talked about a loss rate greater than 0, that is part of the CECL standard. There's not I'm not seeing a conflict, but feel free to email me if you to explain the conflict that you're seeing. Trey, anything to add?
Just wanted to add that in, I think the reference is 326-20-30-10. They talk about this, and there are some circumstances that are listed in the standard where that might be okay, or where an entity would not expect non-payment on something that has an amortized cost basis of 0 and expectation. So it seems like to me the standard, if you come to that conclusion, something you should probably ensure that you're not simply relying on historical information. You might need to check your model. You might want to make sure that you have, if you pulled it out, or make sure you have the right reasonable supportable forecast to go along with that zero ACL. For those who have auditors, they probably will be checking in on this and making sure that there's compliance with policy based on that. So making sure these things are well documented, and especially if you come to 0, it's not full stop, it's understand why, document it, and make sure that you have both current information as well as historical and reasonably supportive future information to support the 0.
Thanks, Trey. And I do recall, I want to add, there are certain investments like treasuries or debt from government sponsored agencies, which the expectation is a 0 loss, which is carved out within the CECL accounting standard. Okay.
Great, thank you. Let's go to our next question, which is, so thank you both. We use the Simplified CECL tool. Are we required to have it tested or validated by any external party? If so, how frequently?
in validation, like with any type of tool you're using, there should be a set of independent eyes taking a look at it to make sure it's being prepared properly, that it's coming to, that it's coming to a reasonable conclusion, a reasonable estimate. With any type of model, there should be some cadence of review of it to make sure it's fitting the complexity and size of your credit union, as well as that it's working as intended. The normal cadence is every couple of years. You do it like the first year, then there's like a rotational cycle. Make sure that over a period of time that you're touching all bases.
Great.
Anything to add?
That makes sense. Yes. Thank you. Next question. Does NCUA plan on utilizing this tool to validate our own CECL calculations during exams?
I'm not aware of any plans or any requirement or any of examiners using the tool.
Okay.
I do know that some examiners will put numbers into the tool to kind of do like a secondary, kind of like do a reasonableness analysis of the results that come from that a credit union may have on their own third-party tool.
Understood. Thank you.
But that's not part of our program. It's examiners, examiners wanting to get the direct result and get comfortable with what they're seeing.
I see. Okay. Next question. Will you please comment on financial assets with zero credit loss expectations? How are these excluded from the CECL tool?
Well, they have always been excluded from the CECL tool. Any type of investments, any type of investments carried at amortized cost, while they are subject to CECL, our simplified CECL tool doesn't calculate credit losses on those type of investments, only on loan portfolios. So if you have investments in treasuries or debt from government-sponsored enterprises, that are guaranteed, the standard, the standard basically allows a carve out where you don't have to determine credit loss on these type of securities. However, there's been questions that come up about certificates of deposits, less than that 250 insurance rate. And again, you got coverage there, but where there are certificates of deposit and other financial institutions, the credit union should take a look at those certificate of deposits and determine whether there's a risk of loss if it's above that insurance limit. It may be infinitesimal, but again, back to that points 1 and 2, because things are forward-looking, there's a potential for risk. That risk should be quantified.
Okay, thank you. Are there any materials available that present the formulas and/or cash flow models used to calculate WARM factors?
The best example is on the FASB site. And if you go to the CECL resources page and scroll down, actually, maybe I can, let me see if I can share my screen and show everybody. Hold on for a second.
That would be great. Are you gonna, okay,
I'm going to share right now.
excellent.
Great. Can you guys see my screen?
Yes, we can.
Okay, and this is how I usually find things. I hit that little search button, type in CECL, hit go. And then I look for CECL resources. And as we scroll down, under resources, Click there. And this Q&A provides an example. So this, this. Yep. And again, the link is on our site. Let me go back. Under CECL resources, FASB. And there it is. Feel free to take the screen back for me. Next question.
All right, next question. Where do credit unions go? And before you take the screen back, Gerardo, we have a question about the tool itself. Where do credit unions go if they need help getting started using the tool? And I know somewhere else someone mentioned, using the tool and related to Warm. So I didn't know, Chris, because it looks like we have a little bit of time, if you wanted to demo the CECL tool at this point. Do you think we have time to do that?
Yes, we do.
So excellent.
So,
And then you can also answer the question about where does one go if they have, if they need help with the tool. Also,
okay. Again, I'm going to go back to CECL. Search on it, and we see the webpage for the CECL, the Simplified CECL tool. And as you scroll down, we have the latest version. And we also have a user's guide, which walks a user through how to enter in data, etc. So that's a good place to begin. We also have frequently asked questions about the tool, which will also help out. We go here, and we have some frequently asked questions. And another item, I talked earlier about the model development document. That shows that gives the auditors, explains to the auditors how the tool works. And then we also have historical loss rates. And if you click upon this, this is a spreadsheet where I'm just going to pick any random credit union. And basically, this shows the value that's in the tool. And then if you click on the main recalculation sheet, although this is very small, this shows all the numbers used to get to the average net charge-off rate that's in the tool. Okay, so those are some nice little tools and documents that you can take a look at to help you learn about the tool. Now, by downloading the tool, okay, hit the file, and then you can click and open it up. I have already put together, I've already updated this tool and put in some dummy data so that we can play around with it. I created so if you're a credit union, download a tool, and in tab 0, okay, you enter your charter number. And in this case, I'm going to say my charter number is 99999, and in it comes up my test credit union. When you enter your charter number, you will see on tab 3, your historical loss rates will automatically populate. Let me highlight that. So these are from the call report, and these are the average net charge-off rates for the last 3 years. So that is automatically imported, pulled, and populated once you enter your charter number. And of course, as of year end, you enter your total assets, and you enter for the loan portfolio categories. And these are the loan portfolio categories that are on the call report, the 13 line items. So you enter your balances here, And these numbers will move into summary tab, loan balance. And you can see here are some loans that we may need to individually assess. So I'm going to go to the next tab, and these are the loans that are perhaps delinquent, where we have superior information about how they're performing. So these are the loans which do not share the same risk as all the loans in your loan portfolio. And one that's usually comes up to mind is the like new auto loans. So I'm going to say borrower, Mr. Auto Borrower, note number 123. And then here you download the loan portfolio segment. Let's say this is new car loans. And this say, new car loans are expensive. So let's say that was a $50,000 loan. And unfortunately, the loan is not performing. And you expect that you're going to be repoing the car. And after repoing it and the costs of collecting the car and selling it and paying commissions and all the costs of disposing of the car, you're going to get approximately, say, $37,000. So we expect a credit loss on this car, on this loan, of $13,000. If I go back to the summary tab, we can see that here we have new vehicle loans, 4 million. We're seeing an expected credit loss on this individually evaluated car loan of 13,000, which is right here. And next, when we go to our when we go to our pooled basis, you'll see our original loans. You see that we're subtracting out the gross value of the loan that we are individually evaluating. And that leaves us the pool that we apply our regular rates to. This is a pool that this is our general reserve. And to this, like I talked about before, we're taking that balance, multiplying it by our loss rate, and then multiplying it by the life of loan. And there's the average life of a new car loan is roughly 2 years. People pay off their loans early, and that gives us, on this whole loan portfolio of 3.9 million, an estimated credit loss of 53,900. Now, what I haven't talked about is whether qualitative adjustments are needed for the loss rate or for the warm factor. And this jumped to where we would put in qualitative adjustments. And, since CECL is forward-looking, and this is a historical rate, we need to think about, hey, what's going to happen to the future? So tab 4 is where we make our qualitative adjustment to both loss rates and to the life of loan, warm factors. So for the new vehicle loans, I have a number here of 56, but it could, we could say, we could take a look and say, okay, when we had our last recession, our losses increased by 50 basis points, and New York, New York Fed's expecting a 63% chance of a recession. That's roughly half, or maybe what we can do is something along the lines of 50 basis points times 63%. And that gives us a estimate of what we think the add will be for if a recession comes. And then this feeds back into our pooled amount. and gives us an overall loss of 40 basis points. And you can see that we now have a total credit loss estimate of 33,480. So that's the way that the qualitative adjustment works on loan losses. Now with the warm factor or the life of loan, this is where we take a look at the loan portfolio. And for the sake of exaggeration, let's say here we have the weighted average maturity of new auto loans being like 65 months. For the sake of being exaggerative, just say that all loans that you have on your books have a weighted average maturity of 72 months because cars are expensive and people want 6-year loans, or actually let's say 7-year loans, 84 months. So we would go and do a pro rata adjustment. Take this 65 and adjust it up. Let's see, I'll do that math right now. I see that we're coming to the top of the hour. Okay. So one thing nice is we have note sheets where you can link I said that was what, 84 months, and adjusted form. Okay. This is to this. So this formula is in the slides, which you'll see, and you see that because the credit union's weighted average maturity is longer, the WARM should be longer, and the difference is an add of 7.15 months. So in here, we're at the. Actually, we need to divide. We've got to do something very important. We need to divide it by 12. Get to years. So here, we'll pull in the adjustment to fine tune the WARM. You see that this number comes through, and we get a better estimate, a refined estimate of what we expect in the way of losses on auto loans. So that was a very quick run through, and I see we're at the top of the hour. Any additional questions?
So thank you so much, Chris and Trey. Thank you both very much. We did have a few more questions, but we've run out of time. What we will do is we will send those questions to you. You can give us an answer, and when we upload the PowerPoint presentation to the learning management system, the questions and the answers will be uploaded there. So with that, I am going to thank you both once again for the great presentation, the wonderful information. That is an amazing tool. That is just awesome. I realize that our credit union members are really enjoyed the presentation about how to use it and its benefit. I'm going to turn it back to Allie.
Thank you so much, Ron. And like Ron said, I just want to take a moment to say thank you from Chris and Trey. We did get a compliment come in, or actually a very, very big thank you, just saying thank you so much for the creation of this tool and coming to the aid of small credit unions with this. So they are, everybody in attendance today is very, very thankful. So I just want to say thank you so much for taking the time to, give this presentation, answer all of the questions, do the demonstration of the tool. So we do really appreciate it. I I do also just want to take a moment to thank our wonderful support staff here, with Ron helping with the Q&A sessions, Gerardo, who has been helping with the slides, as well as George and Christy for assistance, and Franz, who helps with our webinar support. So thank you everybody for just such a wonderful webinar today and for the support. If you're interested in any other webinars that we put on, I'm a little biased. I think they're all pretty awesome, right? We do have another webinar next month that we will be hosting on February 29th on additional sources of liquidity for credit unions. So please join us for that one if you have that time available. I think it'll be a really, really good topic. If you need to reach anybody within the Office of Credit Union Resources and Expansion between now and whenever, we are always available to assist as well. We do have a slide with our contact information. So we have, of course, our LMS resources, like Ron was mentioning. In just about 2 weeks, we will have this webinar available closed captioned with the presentation as well. So we will have a copy of these slides made available to you. You do have to register for an account here with our LMS. We have over 200 courses on how credit union systems work, governance, operations, product services, building partnerships, anything you can think of, we have been able to put a course on up there. We have attached the link as well as a QR code. When you set up your account here with our LMS, please allow just about 24 hours between account creation and that next login, just to allow those courses to generate. Like I said, we've got over 200, so it takes a little bit of time for everything to come together. But please, like I said, if you have any additional questions, we have included contact information for the Office of Credit Union Resources Expansion. If you have any questions on chartering, field of membership expansion, just any questions like that, please feel free to contact us via email or telephone. We also have my specific division as well that works with CDFI certification, grants and loans, learning. We have attached all contact information here. Please feel free to reach out to us with any questions that you may have, and we are all very happy to assist. So thank you guys so much for joining us today. I hope that you enjoyed this presentation. Thank you for your time and attendance, and I hope that you all have a wonderful rest of your day. Thank you guys very much.